Dear Caesar, welcome back to our YouTube channel. It's nice to have you here in Munich for an interview. We are currently talking about the gold market, and I want to know which kind of companies can be found in the market and how can they be segmented.
Yeah, I mean, it's first off, investors need to appreciate that this is a very tiny sector. I think the market capitalization of the entire XAU index, which is the most commonly used index of gold companies, is about the same size as the capitalization of SAP. So it's about 140 billion. Now, there are companies that aren't in that index. So it's a very small sector with a lot of companies, but there are very few companies that are large cap. So it's really a small cap sector. And you're dealing, and gold mining is difficult and expensive, and it's hard to replace reserves. So it's a hard sector. And then you need to realize that it's a capital hungry sector. So these companies are constantly looking for capital. So you need to try and keep your hands in your pockets when these companies are around looking for money. But having said that, there's plenty of potential in the sector because we think the managers have improved their companies and are more and they've structured their cost base in a way that in a high gold price environment these companies will become a lot more profitable. So we think there are opportunities in the sector, and in a high gold price environment that there'll be a lot of good stock performance.
How fragmented is the industry?
Well, it's very fragmented. As I mentioned, there are a lot of gold exploration companies, which we tend to avoid, and there are much fewer companies that are in production. We tend to invest in the larger companies. We focus on companies that are in production, actually producing gold, generating cash flow. And we have some small portion of our portfolio in the development companies. So those are companies that have a proven reserve, but just haven't brought them to account yet. So they're still building the mine. They've got the gold, but they're not producing the gold quite yet. And in that area, the market very often ignores those companies. And so there can be some good opportunities if you're prepared to take the higher risk of whether they'll be successful in implementing their mine plan.
Why do you avoid explorers?
Well, what we're trying to do is to give our investors as much gold in the ground as we can. So if the gold price goes up, we want our investors to benefit. So that means investing in companies that have proven reserves and are in production. So if you're investing in an explorer, there may not be any gold. So if gold goes, it doesn't matter what the price of gold does. If there's no gold, you're not going to do well. Now, that's not to say there aren't investors who do focus on the exploration companies, and they can do very well. It's just not what we do.
Okay, interesting. How is the value of gold miners and gold related? What are the mechanisms when the gold price rises? What happens to the miners, for instance?
Well, I mean, there's a natural leverage. So it may cost a miner $1,000 to produce an ounce of gold. The price is $1,300 per ounce. So if there's a $100 move in the price of $1,400, that's what, a 7-8% move. But if you're producing 1,000 and your margin is 300, then of course $100 move in the price of gold improves your profits by 25% or whatever. So there's that natural leverage, and that's why one of the advantages of owning a gold equity versus bullion.
Mm-hmm. On the vertical of explorers, developers, and producers, how is the market there segmented? Are there more explorers?
Well, I mean, there are lots of explorers. I mean, gold has always attracted people who want to find gold, and if you can find a mine, it's obviously highly profitable. but we focus our attention on the actual producers, and even so, the larger producers. There's one segment too, which is very important for investors to know about, and that is the royalty companies. So the royalty companies are some of the larger gold producers, and they don't have a cost of production. They simply get 4% of all the gold produced from a mine. So if you're a royalty owner, there's no production cost to you. It's all margin. But of course, a lot of the leverage is then taken away. But to the extent the miner finds more gold, you then get your 2 or 3% of that gold. So the royalty model has been very, very successful, especially during this long bear market in gold and gold equities, because they have no cost of production. So yeah, I mean, the royalty companies are the nearest in an equity that you can to owning bullion. I mean, the risk for them is if the mining company goes out of business or the mine closes, then they don't get their royalty, but they still may own the royalty over the ground.
How many companies are in the space you invest in?
Well, our equity portfolios are well diversified between 35 and 50 companies, but there are a lot more companies in the sector, but mostly small cap.
Interesting. In which segments value can be found for investors?
Well, I mean, the best value can be found in those companies which are so-called juniors. Small companies that have gold and are building a mine, because the market always believes that it's not going to work well, and there are going to be cost overruns, and there's going to be a problem in commissioning the mine, getting the mine up and running. So in that area, there's great value, but there's also a higher risk. So it's a risk-reward standoff. So, but that's where you can find some excellent opportunities.
What are your criteria to invest in a miner? What role does the market cap play? What role does debt play? What is the role of jurisdiction?
Well, traditionally, mining companies haven't had debt. Mining is a very high risk activity, so it's all been funded by equity. In the last cycle, when the gold price ran up in 2010-11, companies thought it might be a good idea to take on debt, and that turned out to be an error, because then the gold price fell and profitability was squeezed, and yet these companies had very high debt levels, and that became a huge acute problem for the industry. Companies now have largely paid off this debt, which is good, because financial leverage in a business where your revenue base is so volatile is generally not a good idea. So we focus on companies with low levels of debt. It's not something that we like. It's not something we're used to. So it's important for companies to have a solid balance sheet, good management, and hopefully top-notch, top-class assets.
What are other criteria in your process?
Well, in valuing companies, we look at a bunch of different things. We calculate, what the cash flow is, what the free cash flow is after investments. We look at the price to net asset value. So we look at the future, all the revenues from a mine, and then discount that back to a valuation, current valuation, then compare that with the market. And then finally, we'll also look at how much gold you get for every share of the company. So the market capitalization or the enterprise value per ounce in the ground. So there's a number of different valuation metrics that we use.
What are your reasons to sell?
Well, reasons to sell could be a company that just gets overvalued, and that happens from time to time. Then another reason is that there's a disappointment. The story changes. The company does something that you didn't expect it to do, and so that leads you to sell. Or there's some development at the mine, in terms of political development, or another. There's some problem. So when the story changes, when the facts change, then we might sell. Very often in this portfolio, or in over the last couple of decades, many of many of our investments have actually been taken over. I mean, the largest, most recent example is Randgold Resources, which was a large position in the portfolio that got bought by Barrick at the end of 2018. And in fact, just a couple of weeks ago, a very small position in the portfolio, Atlantic Gold, was bid for cash by an Australian company, St. Barbara. So that was another takeover in the portfolio. In January, we owned some Goldcorp in the portfolio, which had been a big disappointment for us, an underperforming company, and a drag on performance for us. But that got bid for by Newmont Mining, so at a small premium. But hopefully Newmont will do a better job with those assets. So so often the company will actually be taken over.
Who are good capital allocators in the gold field?
Well, that's a small group. That's a small club that could probably fit into this room quite easily with space to spare. But as I said, Randgold Resources and that management team has done a very good job over an extended period of time, and so has Newcrest. Even Newmont Mining has done a good job. And then, of course, Kirkland Lake has had wonderful success with a couple of their recent actually more transactions. But it's hard because it's a tough business, and costs have gone up, and then people made poor assumptions about the price, and so it's tough. It's a tough business.
What do these good capital allocators better as bad companies or bad capital allocators in the gold space?
Well, I mean, it really boils down to the asset quality. So you can be, that's what you need. You just need a good asset. I mean, this is, you need grade. You need a good grade. You need a good asset, and then you need to develop, and you need to be an operator. So it's, as I said, it's a treadmill. And you've got to keep replacing. You deplete your asset every year. You just got to keep replacing. So it's a challenge, no question about it. And the market's punished the sector, and that's why I think there's opportunity now. I mean, the sector has had a horrible bear market. It's down like something 70% from its high, and we think most of the bad, if not all the bad news, is priced in. And if should the gold price rally from its current level, then we think there'll be really great returns from the gold equities. So a lot of the bad news has been priced in. Managements have changed their behavior, we hope, and the future may look a bit better.
How can a desk-based investor analyze a gold miner?
How can a
desk-based investor? Just someone who isn't visiting the companies and doing field research.
Well, I mean, there's lots of information. I mean, you don't feel intimidated by that. The companies all put out technical reports which you can read, and the reserves are very high quality. The rules now are very strict. So when a company says it's got a reserve, which means it's got gold in the ground, proven with a mine plan. So the information is actually very good, and the presentations are very good. The webcasts can be listened to. So there's a lot an investor can do. Who you don't need to visit the mine. Yes, you can get an idea. I mean, it's nice to hear them and meet the management, because management quality has been an issue. And as I said, This is a business that sucks capital. So they're always looking to get capital from you, which is different from a company or a business or a sector which is throwing off cash. They're not so much interested in wooing you. So you just need to have a sense of skepticism and a buyer beware. But there's a lot you can do without having to visit a mine.
What is the reason to own a gold mine instead of gold?
Well, I think return. I mean, the potential for in the gold equities is actually outstanding now because they've been so bad, and if gold moves, you get the natural leverage in a gold equity because they've got a cost of production. You might get some growth. You're going to get a dividend. You're going to get income back, and then you're buying, of course, gold in the ground at a big discount. So here's a sector which has been discarded, disowned, hated, and in a situation like that, sometimes there's opportunity, and we think maybe there's a little bit of opportunity now, but it will need a better gold price. But if the gold price moves up, then the returns in the gold equity sector we think are actually could be really, really very interesting, simply because of how bad they've been and now what they've done to improve themselves. So they've been taken out to the woodshed, given a severe beating. And we think that the behavior has changed, and that might be a good thing looking ahead. As investors, we've got to look ahead, not in the past.
Is there anything you like to share about gold additionally?
Well, I mean, I've been excited and bullish about gold for a while, so I'm a broken record, probably have no credibility at all at this point. But the monetary policy that's been engaged in since the financial crisis, I think is quite extraordinary and quite unprecedented. I mean, to think that you have to pay the Bundesbank 40 basis points to deposit money, and that the 10-year German bond is a negative yield of 20 basis points, and that the US government debt is rising at the pace it's rising, and the other things that are going on, which have just been accepted. I mean, I'm sure we'll look back at this period of in terms of the monetary policy and monetary history and just shrug and go, what was that about? I mean, money should have a price. There should be a price to money. And so in this distorted monetary environment, I think an asset or money, gold as money, has a role to play. And I'm surprised that there hasn't been, it hasn't attracted more attention. And I can only think that the reason it hasn't attracted more attention is that financial assets have done so well. Bonds have been, huge performers. Stocks have done well. And of course, real estate's been on fire. I mean, everywhere I turn in Germany, people are talking to me about real estate in Germany. That was certainly never the case when I entered the business. People in Germany, I don't remember talking much about real estate. They were more invested in and interested in the bond market. So extraordinary and unprecedented monetary policy, I think, will make gold an attractive place for a portion of somebody's financial portfolio.
Thank you very much for the interview.
Thank you.